Welcome back to the Wealth Builder podcast. I'm your host, Nick Donato, financial advisor at Guidance Financial. I always find that people get a little anxious around end of financial year time, wondering if they have or haven't done the right thing, if they've missed or forgotten something. So today, we're going to run through a few different things to consider before June 30 hits. We're going to be chatting about super contributions, self-managed super funds, and a few different other things to consider. So let's jump in. So I'm joined today by Brendan from the guidance team. Brendan, thanks for jumping onto the podcast again.
No worries, no worries.
So we're going to be chatting about, as I said, end of financial year tips and things to consider. I guess one of the biggest things when it comes to end of financial year is super contributions. So when we make contributions either concessionally, which is our pre-tax contributions, or non-concessionally, we have the financial year to contribute those funds, and they go towards that year's caps or that year's rules. So, Brendan, did you want to help fill us in on what concessional and non-concessional for some jargony words, what they really mean and what the caps are?
So essentially with the concessional contributions, the cap each year is 30,000, and that includes your super guarantee payments from your employer. And that's before tax is taken out. So a 15% tax is taken from those after they hit your superannuation account, but really that's about it.
So those contributions, $30,000. So my employer puts in 10, call it. I put in 20, and then I claim a tax deduction in my personal name for that
Yeah.
20, and I get to reduce my personal tax.
Hmm. And the after tax is up to 120,000 a year. And that's after tax, so there's no claiming of personal tax deduction there. It's just a straightforward contribution into your super, um, from your bank account or what have you. Um, and again, you can't you should aim to not exceed that unless advised by your advisor really. So yeah,
So
those are
we've
the
got
two.
that 120,000 non-concessional, just money in the bank account that
Yeah.
we chuck in. But we can breach that cap if we wanted to.
Mm, yeah. So you can bring forward 3 years worth of concessional contribution. Oh, sorry, non-concessional contributions, and that's up to $360,000. That you can contribute in one big lump sum, but then that locks you out over the next 3 years, from making any more of those after-tax contributions.
And I feel like a common misconception on those concessional, so those pre-tax contributions that we can claim a tax deduction on, I feel like a common misconception is that you can only make those via salary sacrifice contributions. Now, we've all heard of salary sacrifice. Your your employer pays you $1,000 per week, and you tell them put an extra $100 into my super as a salary sacrifice contribution. But there's actually another way that we can make those contributions. And again, it is using the money in our bank account at any time throughout the year. But say we're close to the end of the year. So say in June we have $10,000 to spare in our bank account. Might not be the case, but in this example we do. We put that into super, and then we do the relevant forms to classify that contribution as a concessional or a pre-tax contribution, and then allowing us to claim that tax deduction. So if our tax rate was above 15%, and most of the times it would be if we're a full-time employee, if our tax rate full-time employee or getting some investment income as well, rental income, dividends from shares or whatnot. But we get to reduce our personal tax. Again, still gets taxed 15% going in, but overall we might be better off. So that's one thing to think about and consider as we get towards the end of the financial year. Another big one on that is those contributions need to be received by your super fund by the 30th of June. So if you make the contribution on the 30th of June, your super fund doesn't really care. The rules don't really care. If the contribution's received by them on the 1st of July, it gets counted towards next financial year's caps. So make sure if you are going to do those to get in early and make sure you hit this year's caps instead of next. On those as well, is we have an ability to put in more than $30,000 a year through what we call look back or catch up contributions, whichever one we prefer. Brendan, did you want to chat us through that? I know a couple of clients of a few of our clients have used that provision, and yeah, did you want to chat us through that a bit?
Yeah, so let's say that you've had a year where you've, I don't know, sold down some investments and you have a larger tax bill, or you're expecting a larger tax bill than usual. You can utilize some of the unused concessional contribution caps from previous years, and claim those as well by contributing to your super, to help reduce your personal tax liability for that year. Usually that involves people logging onto like their MyGov account and finding out how much they have in unused caps, and then making contributions in line with that. So yeah.
And the big one around that is around the eligibility piece. So to be eligible for that, our superannuation balance or our total super balance in all of our funds has to have been under $500,000 on 30 June or 1 July starting the year. So at the start of the year, if our balance was sitting at $490,000 and throughout the year it's grown to 550, technically our balance was under 500 at the start, so we do still have access to those provisions. So it's one to watch what our balance was at the start of the year. And again, as Brendan said, jump onto MyGov and that it can detail exactly what you have left or the look back or catch ups that you can make. And we've seen it very common when people sell, again, large parcels of shares and incur large capital gains tax bills, or sell an investment property and again have a large tax bill that they want to pay. When selling the property, it's also the contract date. So the date you sign the contract is the date the capital gain is assessed. So say we sign the contract on 1 June with a 90-day settlement, we pay tax on that sale on 1 June or for that financial year, even though we don't receive the money until August 2026 or August the next financial year. So that's one thing that I see may catch out some people. There's a couple of other different, rules and benefits when it comes to making contributions, some spouse contributions and some government assistance when it comes to making contributions. Brendan, have you seen a few of those this year as well?
Um, we don't tend to get an awful lot of government co-contributions come through. Spouse splitting and contribution splitting, however, do pop up a bit.
Yep. Did you want to talk us through what that government co-contribution was and how people might be able to get that little win?
Yep. So if you are earning less than $47,488 a year, to be a bit more specific, you can contribute up to $1,000 of your own money, and the government puts in 50 cents for every dollar you contribute up to $500. It does slowly sort of scale back But the general rule of thumb is that for every 50 cents you put in, for every dollar you put in, the government puts in 50 cents. So yeah,
Lovely. So we put in $1,000, we get 500 back, or well, not back, it automatically gets contributed to our super. 47,488, as you said, is the to get the maximum benefit all the way up to 62,488. So if our salary or income is somewhere in between, we might only get half of it or a quarter of that $500 benefit. Spouse contributions as well is around how much income you've earned. So spouse contribution, my spouse is working part-time, has taken time off for maternity leave, stays at home, and doesn't work, or something like that, or just has a lower salary. If they earn under $37,000 for the year, what we can do is I can put in $3,000 to their account, and I get a tax offset of $540. So I benefit my tax at the end of the year by $540, and their super gets topped up along the way. Again, there's a tiering system for that. If you earn over $40,000, there's no benefit or that benefit doesn't exist. But again, that is a common one that we do see quite a bit, especially if there's a difference in super balances, and we want my partner to, equalize, so to speak, and top up their fund or her fund a bit more in my situation. And that also goes hand in hand with contribution splitting, which, aims to do a similar role. Brendan, you said we've seen a fair bit of contribution splitting as late.
yeah. So people choosing to contribute up to 85% of their um concessional contributions that they've made that year. Um, that 85% number is a 70% benefit going straight into the partner's account, with 15% of that being taxed. Um, but but yeah, another way to sort of move to level out the two supers between two partners, I guess. Especially if you're in a position where, say, you might be getting close to the transfer balance cap, which we'll be covering a bit later on.
Yep. So that's it. So you can, or by doing a couple of forms in July or in next financial year, you can automatically split or transfer, for lack of a better word, 85% of your concessional contributions to your spouse's account. So rather than Brendan, you mentioned 70%, you can actually get the full 85% across. You can't get 100% because 15% is discounted for tax, and then we can move 85% of whatever we've made across. So uh, I make $10,000 of concessional contributions. I can transfer 8,500 of that over to my spouse's account.
Right.
And all of this, comes into play and has to be received by the fund by 30 June. And all of the same super rules still apply. So if you are making these contributions, you just have to be aware that you can't touch the funds until earliest age 60. So liquidity can be an issue. So those are a few things to consider. Next year in 6 weeks, the caps increase as well. So rather than the 30,000 concessional, it goes up to 32 and a half, and the $120,000 non-concessional or post-tax goes up to $130,000 as well. So it'll be a different conversation next year compared to this year. The other big change coming in from 1 July as well, as there is a change to tax rates. So this isn't really under financial year planning per se, but it's good to think about. So next year the tax rates are changing. The second sliding scale threshold, which is 18,200 to $45,000. Currently it's taxed at 16%, and that's moving to 15% from next financial year. So a bit of a tax cut in there. We've talked a lot of numbers, a lot of caps, so a bit of jargon in there, but hopefully we all followed along. And, if you did have any concerns about your super strategies, you can always book in and we can help you out and see if it all aligns to your goals. The next thing on our agenda is around, as you said, Brendan, transfer balance, caps, and pensions. Did you want to take us through a bit of that?
Sure. So transfer balance cap, essentially is just the maximum that you can move into an account-based pension. At the moment, it's $2 million. And as of 1st of July, that'll be increasing to $2.1 million. Generally, you wouldn't take take too much notice of this. You would just sort of roll over into a account-based pension, unless, of course, the government sort of flags that this will be changing relatively soon, at which point, then it's worth discussing with your financial advisor whether or not you want to hold off, maybe wait for the changes to come through, or just lock in the pension straight away. But that's on a case-by-case basis, really. Yeah.
And even if you are below that $2.1 million cap or the $2 million cap, if you've already used it, there is a bit of a pro-ratering that occurs when the cap does increase. Now, that isn't really relevant for our audience that are in their 30s or 40s or even 50s. It's more when we're closer aligned to retirement. So it affects those potentially about to retire and start these pensions, or those who have retired and already commenced a pension. But that's another change to the superannuation system that is coming in as of 1 July. So along with the contribution caps, every few years, along with inflation, they look at the numbers in the background, so to speak, and decide to increase the caps when the markers get to a certain level. Along with superannuation, a lot of this superannuation talk comes to our retail and industry funds, as well as our self-managed super funds. But self-managed super funds, there's a bit more onus, or there's a bit more to consider when it comes to end of financial year plannings, because those who run a self-managed super fund are the trustees or the directors of their own fund. So what are some things to consider when it comes to end of financial year planning for self-managed super funds?
I think the biggest one is making sure that you've paid all of your minimum pension payments before 30th of June. You don't really want to get caught out having failed to meet your obligations as far as that's concerned. Usually, and I don't want to downplay it in any way, shape, or form, but usually if you've made an honest mistake, and it's a relatively small amount, the ATO might turn around to you and say, "Hey, make sure you make these payments as soon as practical or as possible." But if there are more serious or more egregious mishandlings of those pension payments, then more serious penalties can definitely be applied there.
Yep, 100%. And again, more relevant for our older listeners. Apologies for calling you older, but more relevant for our listeners that have pensions already. Another one to think about or consider, and again, this isn't really under financial year, but same as we're reviewing our contributions, reviewing our pensions or our self-managed super funds at the same time, one good tip or one thing to look at is your beneficiary nominations. That a beneficiary nomination is the instructions to your super fund or your self-managed super fund on where to pay the funds when you pass away or you're no longer here. So not a fun conversation to have for anyone, let's not lie. But some nominations do expire every 3 years, so we may need to renew them. Some nominations can be non-lapsing, so they don't expire until you change them if you do change them. So you may as well jump in there and sanity check your beneficiary nomination as well, making sure that it aligns with your wider estate planning scenario or wider estate planning goals. One that does become relevant as well for our younger listeners is to ensure we have enough in there. Again, we're checking our balances, we're checking our contributions. Make sure we've got enough in there to pay for any insurances that we hold inside super. Throughout the year, our premium might have gone down if we do have insurances in there. So just make sure that we've got more than what the minimum is to keep the account open, and then some more to fund your life, TPD, income protection insurance, whatever you may hold. So that's one thing to look at as well. So outside of superannuation, self-managed super funds, there's a couple of other things to consider, review when we're ticking down the days towards the end of the financial year. Brendan, what's one that you would think about when it comes towards the end of the financial year?
I'm a big fan of reviewing my portfolio, my super portfolio, making sure that no, there isn't anything in there that, you know, maybe wasn't a particularly clever decision by my part. I personally tend to manage mine maybe a little bit more than others. So I would review it, and while reviewing it, making sure that maybe I don't realize any CGT that may not have been necessary. If my strategy does decide to change for whatever reason, that's one that definitely sticks out for me.
hmm Making sure that it aligns with your future goals and whatever
Hmm,
they are, both super and your non-super investments as well, I would say.
yeah, I think it's a
Um,
good time of year to just sort of sit down, have a look at everything, and just make sure that everything's still going, trucking along as you sort of intended, I guess.
yep, yep, and especially with your non-super stuff, so just the investments in your personal name, in your family trust, in your company, wherever they may be. Um, Around, if we are rebalancing the capital gains tax potentials that may occur, whether again we've had a down year of income, and those contributions can offset some capital gains if we do decide to sell some investments, whether we've held on to some investments that we don't think are viable anymore and aren't going to come back. Hopefully that doesn't happen, but in some instances with investing it does, and whether we're going to cut our losses, so to speak, and
Hmm.
incur a capital loss that might offset a few of our capital gains that we've hopefully made along the way as well. So there's a couple of things that you can consider again around the tax planning and selling investments if appropriate for you. The one thing that sticks out to me would be charitable donations. So I guess donating to charity can be used as a tax deduction when it comes to tax time, so it can help to reduce your personal tax payable. So as long as you're contributing to a registered charity, so you know, most of the or all of the big charities I'm sure we've all heard of before, the cancer councils, the White Ribbons, Vitamin D, which is coming up in a few weeks with their big big freeze. So there's lots of different charities out there. So if you did plan to give, you could consider doing it before 30 June to use as a tax deduction. If you have already given, you can, make sure you keep your receipt so you can claim it. But that's just one thing to consider, and I bear in mind that there is a cost of living crisis, so to speak. So it may be difficult, but that's one way that you could look to reduce that tax in the short term. So those were the few things to consider. Did you have anything for the people with family trusts or businesses to think about as well, Brendan?
Um, I suppose the first thing that sort of stands out with, and this is probably more to do with changes that might be happening down the road, is the changes to the taxation treatment within family trusts. Maybe just reviewing it with your financial planner and your accountant as to whether or not it's still viable, depending on what it is that you're trying to do or what you're trying to achieve with those. Um, is there anything you need to do within it, within the trust structure, or whatever, whether that be distributions or resolutions or what have you, that need to happen before the end of the financial year as well. Um, that's probably something that anybody that has a family trust or just a trust structure in general should probably be considering coming up to this time of year.
Yep, 100%. Chatting with your accountant to see if we do need to distribute that income or how we are going to do that, see if anything needs to be resolved on those tax changes. Again, still all proposals hasn't been legislated yet, so it's a wait and see. It seems that they more likely will get passed through and legislated, but who knows? We just got to wait and see what happens on that piece. The other one, again, so that's family trusts. Again, chat to the accountant, make sure we're all on track to do what we need to do. Business owners, a change from next year, if you do have staff members, that you have to pay super contributions at the same time that you pay wages. And again, that's a good thing to know for employees as well. So every time you get paid, if you get paid fortnightly, monthly, weekly, you'll also get paid your super contributions in that occurrence in that pay cycle. Um, so that's a one to consider, or one to not consider. It'll just happen automatically for the employees. Business owners, I'm sure, are all across it in having to do that. So that was it from us. There's a couple of tips and a few things to consider in there. Thanks for listening along. Thanks, Brendan, for joining in for this podcast as well. That's a wrap on today's episode of the Wealth Builder podcast. Yeah, thanks to everyone for listening along today as well. There might be a couple of action items that pop to mind when it comes to end of financial year time. And if you did need any assistance or wanted some advice before you made any changes, which would suggest, feel free to reach out. If you found this episode useful, feel free to share it with a friend. And then, yeah, jump onto the guidance website and check us out. But I look forward to bringing you the next episode in a fortnight's time. Until then, have a great day.